Equities rallied once more last week, coming amid a dovish repricing of Fed policy expectations after a cooler than expected slate of US data, including lower JOLTS job openings, a downward revision to the second quarter GDP print, and Friday's non-farm payrolls report showing further signs of labour market softness beginning to creep in. Despite that, and a rally at the front end of the Treasury curve, the dollar continues to gain ground against all of its G10 peers, extending its winning run to its longest in almost a decade last week. Looking ahead, a quiet calendar awaits this week in terms of economic data, but markets move past Labour Day, heralding the end of the summer and perhaps a return to more volatile trading conditions. As always, plenty to discuss on the trade-off this week. Without further ado, let's get into the show. So a busy show as always this week. Let's bring in my co-host Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, I've gone tieless like you this week, but that's only after my tie had a bit of an accident with a coffee cup on the train in this morning. So hopefully your week has started off in a little bit of a better vein than mine has.
Yeah, it certainly has. We're in the twilight of summer, as it were. Kids going back to school this week. We can get back stuck into markets with real gusto, I think. But enjoy the weather while we've got a little bit. Of course, it's brightened up here 2 days before the kids go back to school, whereas it's been raining all through the summer holidays. But that's life, isn't it?
Oh, it's far too hot. It's going to be too hot all week, isn't it? We just can't cope with the heat in this country. But don't look too happy about the kids going back to school, mate. You never know; they might be watching.
Yeah, I doubt it. They're probably plugged into some crap on YouTube or something. Probably,
hang on, that's what this is,
show.
Well, in any case, let's see if we can do better than Ryan's other show in Topical Thunder. Right, I want to talk about the jobs report first of all. Non-farm payrolls are almost bang in line with expectations on Friday, coming in at 187,000. I think the Bloomberg consensus was around 170. So pretty much in line, given how wide the range is for payrolls these days. I think it's an interesting number. When you take it in isolation, you would say, well, yeah, this represents quite a sharp slowing from the last 18 months or so. And there's been a lot of talk on Twitter about this and the slowest pace of jobs creation in a couple of years, et cetera, et cetera, et cetera. But I think there's a few things we need to just clarify here. And the first is that you've got to remember that the last couple of years have all been recovery from COVID. There's been so much distortion in the data that actually, I would argue, from kind of June 2020 to June 2022, you're better off just ignoring whatever happened there, because it was all a mechanical rebound from the lockdowns that we saw during that pandemic period. And the second thing I'd say, just to add a bit of context around the number, 187,000 is well above actually the 100-ish thousand that you need for job growth to remain in line with population growth. And it's pretty much in line with where we were in 2018 and 2019, when we were in a late cycle US economy as we are now. So yeah, it's a clear slowing in the labour market, but I don't think it's time to panic and start battening down the hatches just yet. Other parts of the jobs report a bit more interesting. Unemployment rising up to 3.8 from 3.5% prior. Again, on its own, you'd say, whoa, that's a concern. That's a big rise in unemployment. But this is why you need to take the report on the whole, because it all came as a result of a rise in participation, which is now at a new cycle high of 62.8%. So yes, unemployment is higher, but it's because more people are coming into the labour force. More people want a job. More people are looking for a job. So it's very easy to frame that as a positive. And the cooling pace of earnings growth down to 0.2% on a monthly basis, that's going to set aside some concerns about a potential wage price spiral, particularly if there's any of those emanating from some of the hawks over on the FOMC. So I'm keen to get your thoughts on this, Ryan, but overall for me, I'm thinking, it's a decent report. It's Goldilocks-ish. The jobs market is still resilient in the States. Yes, it's slowing, but we always knew that it would. I think it probably tips the balance marginally in favour of the Fed, having already concluded their tightening cycle, but they were never going to go in September anyway, and we've still got plenty of data to come before the November meeting, and they're not going to tell us they're done in any case. So what I think is really interesting is the fact the market is now pricing in a 25 basis point cut from the Fed in May next year, which I just can't see that happening, mate.
Well, we're going to be playing this cut trade on and off now. Well, probably from now through the end of the year into early next year. So it's not a surprise. It's not a surprise to hear the market looking at the glass half empty picture. Jobs sub 200,000 now and staying sub 200, and maybe we are just starting to trend lower. But all the other metrics, like you pointed out, all looking pretty solid. The unemployment rate going up yet, that participation rate. I mean, the one thing I would say about that participation rate, yes, you can quantify it in terms of what happened with the unemployment rate, but the other side of the coin is, why are we getting an increase of people coming back into the market? Is it because they're running out of cash? Is it because they can't make ends meet? And people, retirees or others, are forced to come into the market, savings has gone, that sort of thing. If we continue to see the participation rate growing, that would be more of a negative signal than a positive signal. You want to see that in a growing market when the economy is doing well, not when it's softening. So that in itself can tell its own negative story and maybe put another negative slant on the jobs picture. But for now, you've just got to go with the numbers. The numbers were okay. There were no disasters in that at all. Wages, even though they dipped back a little bit, still pretty hot. And as further inflation comes down, the more the real pay growth divergence maintains, and that's something that the Fed will be happy with, to see that pay growth is above inflation, meaning that money can then start to stretch a little bit further. It's not all getting eaten away. So two sides of the story with this jobs report, continuation as we've seen, but also maybe just some other little elements that are turning that we need to keep a close eye on.
Yeah, in many ways, it was one of those reports where it's just going to confirm people's priors. I mean, I've been relatively bullish on the US economy for some time. So for once in my life, I'm looking at something glass half full rather than half empty. Wow. I know, shocking, isn't it? But then there's also those out there, bad news sells and all the rest of it. These people flogging newsletters or whatever it is on the internet. Of course, they're going to try and frame it as, doom is coming. And of course, my newsletter will be able to protect you from whatever's happening. So, no surprise that there's plenty of that out there. But just to round up on the labour market, of course, the Fed want to see below trend growth. They want to see the labour market soften. They've acknowledged that they need to see that in order to bring inflation under control. So lower wage growth, higher unemployment marginally, slowing payrolls growth, and also job openings slowing, the quits rate coming down a little bit, the vacancies to unemployed ratio coming down. They're all the things that the Fed actually want to be seeing. So I don't think this is going to cause any sort of panic over in DC when we hear from Powell and co. in, just over 2 weeks' time.
No, exactly. But you've got to wonder, are we just going to see a slippery slope lower in all the numbers, or are we going to hit a cliff and then dive off it? And that's what they'll be worried about. They don't want to see things heading over the edge of a cliff and then everything's going to hit the fan if that happens.
Come on, I thought I was the downbeat one on this programme.
Oh, you've got to look at both sides of the trade, mate.
Right, come on then. What's going on elsewhere? Because if we're going to look at things that are going off a cliff, shall we look at China?
Yeah, well, talking about the economics and the fundamentals, and we are still seeing this economic weakness, and everyone's really in the same boat. There's been no real let up in the weakening data. The final manufacturing PMI is mostly confirmed a slight improvement, but all but a few still in contraction, and heavily in contraction for some of them. China, the Caixin index moved into expansion there, so a little bit of heat off there. US job steady, as we just said, but we are seeing a bit of wobbles in the unemployment numbers in Europe. All this gives the CBs, some work to do into the latter part of the year. Do they move on growth if growth is weakening, or do they continue to move on inflation? And central banks like the Fed, the ECB, BOE, you've got to remember their mandates. They are all focused on price stability and keeping inflation under control. But last week we saw inflation rising in Europe in particular. We've already seen it happening in the US with the CPI. Then we saw it in the PCE. Inflation has jumped in many countries and remains for some well above target. The US, France, Germany, Spain all saw higher inflation last week. If it starts a new trend, the pressure will really start to mount on central banks. And, the difficulty for us trading it is everyone is largely in that same boat. So who do you buy or sell in that scenario? I think it's going to be difficult to try and pick trends out of this. So being reactive is going to be the way to trade it. Go with the data points. If someone's looking a bit stronger, then you need to side with that sort of bias. play the strongest against the weakness, or in this case, the less weak against the most weak. And I think that's what we're going to be looking to trade over the next few months.
Yeah, I think I very much agree with that. I was actually speaking with someone on Friday morning, and we're actually moving into that second part of the very broad guidance that central banks gave us 18 months or so ago. It was higher for longer. Well, higher's done. Now we're into the longer bit, and the question for any trader out there, primarily foreign exchange, of course, is who stays high for the longest period of time. Is it going to be the Fed? Is it going to be the BOE, the ECB, whoever? It's certainly not going to be the Bank of Japan. They haven't got off of the negative rates just yet. But I think that really is the question, and that all stems from who pivots to looking at growth first. And obviously there's two things really that can spark such a pivot. One would be inflation coming down substantially. I don't mean, like we saw in the Eurozone core going from 5.5% to 5.3%. That's still far too high. You're thinking getting back somewhere near target. And the second would be if growth was so cataclysmically bad that it gave a central bank absolutely no choice but to focus back on that side of the equation. And you then start to think, where do the risks lie? And again, it comes back to China, and again, it comes back to Europe as a spillover of that.
Yeah, and we've been saying it pretty much all year, expecting growth this year to be a bit anemic, nothing really bad, but nothing really good. And I think if that's the case, that's as soft landing as you're going to get. But, as you mentioned, talking about the NFP, what central banks don't want to see is economies going off a cliff. That sudden, flat GDP minus 0.2 GDP is suddenly down 1% GDP. That's the sort of thing they will be worried about if that happens. But, apart from that, we've had the same theme. If you have to pick it now, pick a country now or two, you think the US is probably going to come out of it the best of the bunch. Europe, you never know with those guys. I mean, just look at Germany. They could drag down the rest. The UK still potentially raising rates, still face probably more of a cliff edge than other countries. So there are runners and riders there you can look at and think, right, well, they may do better than those, but it has to be backed up with the data now.
Yeah, absolutely. While we're on this subject, it just reminded me of the ONS on Friday morning and their GDP revisions. I just wanted to make the point that the media and social media and television and print, particularly papers that are printed on pink paper, over the last 2 years, have constantly been downbeat on the UK. They've been underselling the country. They've been slagging off the economy at every point, slowest recovery in the G7, worst performing in the G7, et cetera, et cetera, et cetera. Well, the ONS revised their GDP estimates on Friday. It turns out that rather than being 1.2% smaller than before the pandemic at the end of 2021, the economy was actually 0.6% larger, which not only goes against the first claim, which was that we'd never recovered from COVID in the first place, but it also goes against the second one because it puts us right in the middle of the pack when it comes to other G7 economies. And I just wanted to make that point because, well, one, it's a bit of good news on the UK, and that's in short supply at the moment. And secondly, what's annoyed me the most is that, we've had front pages and endless column inches taken up with this utter tripe about the UK being the worst performing economy. Suddenly the data's revised and no one says anything and tries to sweep it under the carpet.
Well, I might try and earn myself a couple of quid. I live by the sea. I'm going to go and fish out some seaweed, send it to them. They can hang it up in a cupboard because that'll give them better economic predictions looking at the seaweed than it does what they do now. You can throw the OBR, the Office of Bodge Responsibility, into that hat as well. We've got all we can do is trade it. What they print, we trade. That's it. So what we believe in it. Like Chinese data, it makes see nor there. The numbers are the numbers, but it doesn't surprise me that they cock it up. The BOE, they've got Ben Bernanke coming in looking at how they do forecasts. What's going on?
that will solve everything. Right. Before we get in trouble and slag someone off that we shouldn't, let's move on to our third topic, subject, whatever we want to call it, it is basically the end of summer now. Rather amusingly, as Ryan said in his introduction there, we've moved past Labour Day, the kids here in the UK going back to school, and the sun has come out to play, and we've got a bit of a heat wave going on here in Blighty this week. But for markets, I think Labour Day, we would all say, marks the end of what we would call kind of traditional summer markets. And what's most interesting about that is that it's not at all unusual for us to move into the early part of September and everyone to come back from their holidays, desks start to fill up again, liquidity improves, volume improves, etc., etc. But more importantly than that, a lot of people will start to reassess some of the themes and the narratives that not only did we go into the summer break with, but also that kind of built up a little bit of a head of steam over the summer as well. So I'm starting to wonder, are we going to see the same happen again this year? I mean, if you start to think about what some of the big themes in the market are at the moment, just merely sort of questions to mull over more than anything else. You look at the dollar. As I said in the intro to the show, that the dollar's up for 7 weeks in a row when you look at the dollar index. That's its longest winning streak since 2014 on a weekly basis. It's very unusual for anything in the FX market to go up and to the right in a relatively straight line for a prolonged period of time. So are we going to see some profits taken off the table there? Is the trend going to pause a little bit, perhaps? You then look at China. Are concerns there reaching a little bit of a peak? I mean, we haven't had China worries on the front cover of The Economist just yet, but it does seem like everything you read is bad news at the moment. So you question how much more negativity could actually be priced in and whether a turnaround could maybe be on the cards there, depending on, of course, the amount of further stimulus that's delivered. Of course, you've got the geopolitical shenanigans going on as well. There's still war in Ukraine, that counteroffensive reportedly gathering a bit of traction. But I saw on the way in this morning, when I wasn't spilling coffee all over myself, that Zelensky has sacked his defense secretary. So what does that mean for the state of the war there going forwards? Of course, China and Taiwan is another issue entirely. And then you've got the equity market. The bulls have been in charge for stocks for a couple of months now. We're going into September, which, as my dear colleague, some bloke called Chris Weston, said a while ago, it is historically the worst month of the year for equities, particularly on Wall Street. So could we see the bull run start to get derailed there? So, Ryan, what are your thoughts? Do you think some of these themes are up for reassessment and reevaluation as everyone comes back off their sun loungers and starts to think a little bit more seriously about markets and about work once more?
Yeah, very much so. I think you've almost got to draw a line over the last few weeks, because we've been sitting in our chat room and it's really been hard to pick a side. You're bouncing off of levels, you're thinking that a range is going to break, it fakes you out, it sucks you in and spits you out again and back into the range it goes. So it's been very hard to, pick a theme. And by nature, I'm a long-term trader, so I like the big themes. I like to see if I can get in early on those and, get a trade on. But the last few weeks, it's just been a case of reacting to the headlines, scalping off the levels. But I think, you've got to draw a line over the last few weeks, and what happens from tomorrow or when you see this show and for the days ahead, how the market sets itself up early could give us an indication of what's going to happen going in. We talk about China. We had some rate changes again last week, mortgage changes, and all of a sudden the yuan isn't weakening as much, and it's reacting by strengthening to those moves from the PBOC and authorities. And that just gives you a little indication that although things might be bad in China, easing, doing more on rates, cutting rates doesn't mean it's going to be weak for the currency anymore. It means that it's good for risk. The market's saying, they're stepping up, they're doing something about it. So therefore, we're happy to now buy the yuan, and we've seen that strengthen a bit. It's also underpinned the Aussie and other commodity currencies like that, and currencies that are close knit with China as well, that have big trade with China. So we are starting to see these little twists and turns, but as you mentioned, the dollar has been strong, up for, 7 weeks, you said? But Indeed. When you look around all the different pairs that make up that basket, it's not all one-way traffic. So it's not, you can't look at any one pair and say, the dollar's strong today, because levels in like the Kiwi and Aussie dollar down below are still holding. But we've got to see what happens over the next few days. And as we're going to look at in a minute, what's going to come from all the central banks.
Indeed. Well, go on then. Why don't we get on to that? Because I was looking at this yesterday and I just sat there at my desk with my head in my hands for a good 5 minutes.
Well, listen, we've had peace and quiet. We've had the break from all the central bankers. They've all been off on their jollies, down at Lagarde in the south of France, or wherever she likes to top her tan up. I don't know where Powell goes. He likes a good concert, so he's probably been rocking around some of the concerts over in the US. But I saw the roll call of the speakers this morning, and that was my indicator that summer was over. A slate of ECB pods all popping up, and you think, oh, right, yeah, summer's done. So the relative peace and quiet is going out the window, and this is going to be a very busy month. And looking at the central banks, looking at the majors, we've had the RBA already by the time this show airs, so we'll see what those guys are going to be doing. Are expected to pause. So maybe we'll see if there's been a little bit of a shock there. We've got the Bank of Canada Wednesday. Then on the 14th, we've got the ECB. And then the third week in September, we got the Fed on the 20th. Then we got the Bank of England, Riksbank, Norges, SNB on the 21st. And then on the Friday, I think, the 22nd, it's going to be the BOJ. So a really big week coming in the latter part of September. Now, most of these have had or are still having extended periods to assess their data. So it's been a good, 6 weeks, 8 weeks between meetings. So their decisions this month are really going to define the rest of the year. And there's not much to say about the RBA, as we said. It'll be out by the time this airs. But I think that the Bank of Canada Wednesday is something to look at. They're largely expected to go back on hold. The data could really be a decider for them. CPI jumped in Canada to 3.3% from 2.8%. That again is well outside bit outside the Bank of Canada's target 1 to 3%. Core still sticky at 3.2%. Q2 GDP was flat. Year on year came in at 1.1%. Quarter on quarter annualized down 0.2%. So again, that anemic type of number. So there's two considerations that they'll face, as will all the central banks. Will they worry about inflation or worry about growth? For trading it, I think this one could be interesting at the Bank of Canada because we have their jobs number on Friday. So if they do paint a dovish picture on Wednesday, that could be added to or reversed on Friday by that jobs numbers and vice versa. So you're going to get a good indication of what central banks are going to be lining up and then how that plays off against the data.
Yes, absolutely. I mean, there's, as you say, there's no point in talking about the RBA. I mean, people know what it is by the time they see this. I don't think they're going to do anything. I mean, I think most Aussies will be glad to see the back of Philip Lowe. Of course, this is his last meeting. He's almost as hated over there as Andrew Bailey is over here. So I don't think there's going to be many tears for his departure. I think the Bank of Canada could be interesting. I mean, I don't know Canadian economic data as intrinsically as I would like to think I do that of the UK or the US, but I would expect they've probably had at least some sort of a wink or a nudge as to what that jobs report is going to look like by the time they make their decision on Wednesday afternoon UK time. I reckon they're going to go back on pause, data dependency, leave the possibility of a hike on the table, but not really lean into that too much. I don't think we've got a press conference with this meeting or new forecasts, so that may perhaps just dent the desire to do too much in terms of forward guidance. But it is going to be a very, very busy month, as you rightly said. I think the key thing is, as we alluded to earlier, we are getting to that point now where central banks are either very close to or already completed their tightening cycles. We just go through that list that you mentioned. The ECB, I think it's basically a coin flip whether they go once more at this meeting and then that's it. The Fed, there's a 1 in 3 chance they go before the end of the year. The BOE market's still priced 2 hikes, but everyone really thinks they're going to do 1 and then that'll be it. The Swiss National Bank, they're probably done, as we touched on last week, and the GDP figures out of Switzerland were a bit soft this morning. And of course, the Bank of Japan, well, no one expects them to do anything anymore. So it is going to be a very, very big month. And I think long vol, short sleep might be a bit of a trade for the next 3 weeks or so.
Well, you should have made that your play of the day, mate. But I agree with that. And I think all the central banks, the Fed, ECB, Bank of England, I think they've probably got one more hike in them, just to seal the deal. Maybe just send that little message to the markets that they're not switching off regarding the potential inflation shocks. But once we get those hikes out of the way, unless we do start to see a real trend up in inflation, I think they're all going to be done.
Yeah, I agree. I couldn't have made that my play of the day, mate. I spent long enough with the Bloomberg help desk already. If I was asking them to find a ticker for my sleep patterns or anything like that, we could have still been there now rather than recording this show.
Yeah, well, I don't know. You need help desk on 24/7 open line, I think, mate.
Oh, I think I do these days. In any case, I was able to make some charts, so let's have a look at them in That's the Setup. Right. I want to look at crude, first of all. Not something we look at overly often, or I certainly don't on this show. But it's an interesting one because I think the momentum does look to be firmly with the bulls now when it comes to, well, this is WTI, but with Brent as well. And that stands on both a fundamental and a technical basis. There's a lot of fundamental factors driving the oil price higher at the moment. A lot of focus on the supply side. OPEC were out last week with various sources reports that they're going to extend their output cuts for another month. You've got continuing concerns about the weather. In the United States, it does seem that hurricane season has taken quite a significant step up, actually, over the last week or so. And there's a few other areas of interest, I suppose you could call them, maybe heading towards the Gulf of Mexico. So just a little bit of risk priced in there around a potential lack of production as that weather moves through. And also you've now got other supply risks coming in as well. I think there were reports on Friday about some strike action taking place in Nigeria, and that was what gave crude the latest lift through that $85 a barrel mark, which it sliced through on Friday. And that's an important level because it's psychologically important. It's a round number. Price is now at its highest level since last November. And it's going to be interesting how price reacts if we do get a retest of those highs around the 85.50 level. But if we do hold on to that, then I would certainly be favouring upside for now, both the technicals and the fundamentals looking to align. To the upside, of course, we have 87.75 and then maybe even the $90 a barrel mark as a bit of a stretch. And there's a golden cross in there as well for people who like that sort of thing, just to add to the list of factors that may be on the bullish side of the spectrum. The other thing, of course, to be aware of, inflationary implications and growth headwinds if crude does continue to rally. But I'm liking this higher for now.
Yeah, this is an interesting one because we did look at it quite some time ago and quite often because we were looking at whether we're going to get the break of that 83.50, 82.50 area that was really been solid throughout the last few months. And it had that little pop above, which didn't last long, and then we went back below again. So this break does look like it's got some legs behind it. If we get down, 83.50, 82.50 would be the levels I'll be looking at for wanting to see the price become supportive down there. That will then give it another impetus to leg higher. But yeah, I maybe there is a lot of weather in this. It always happens hurricane season if it impacts the coastline and refineries and whatnot. So we'll have to see whether this is sustained or not. But the way we'll see that is if we test those levels and they hold. But if they do, then we may be seeing up to $90 mark. And then again, you've got those inflation implications coming in there, and that'll all go into the pot 3 to 6 months down the line.
Absolutely. It's interesting that crude's rallying as manufacturing PMIs just get worse and worse and worse. That's the one kind of nagging concern that I do have about further upside here. But in any case, let's have a look at Kyriakos's fancy new animation and go to dollar CAD. There we go.
Oh, look at that. Amazing. Brilliant. Well done, Kyriakos. I love it. Love it. I wish I was quick with my mouse. I'm behind already, but there we go. Anyway, so you're looking at oil, so it makes sense to look at dollar CAD, which is obviously a big follower of oil at times. We talked about Canada and the BOC and now oil. Right now, the oil CAD correlation has been on and off, and it's been more off than on recently. It's, dollar CAD's holding its gains even as oil has made this spike higher. Now, this could be traders waiting for the Bank of Canada, before flicking the switch and getting back on the oil bus, as we like to call it, which could mean we get a double reaction if the BOC are hawkish. Then you'll have traders buying the CAD on the back of that, and then maybe the oil traders will dip in and start buying CAD as well on the back of these oil moves. So it could be extra spicy, this one, as we said, for the Bank of Canada, whether the correlation suddenly switches back on again. Now, if that does happen, I can see a serious dent coming to that 135 area. It's been a strong one to trade. It's held pretty well. Had a little mooch under, let's call it that, a week or so ago, but we're back above pretty quickly and holding again. On the other side, if you get a dovish Bank of Canada, then we're likely to have another test of that big 136.50 area. It's really been a bit of a brick wall of late. Now, I've been long this from down in the 131s, and really the next size, which way we go, is a bit of a coin flip. So for all the data and central bank talk and all the action, the chart is really simple to trade. Either we're going to break one side of this 135, 136.50 range, or we're going to stay in place. So that's what I'm going to be using as my guide to trade this one. As I said, I am still long, so I'll be looking to see if we break to the upside. But I'll be very cautious if we don't and we suddenly break that 135, maybe 134.70. That'll look a bit more bearish.
Yeah, it's an interesting one. I mean, there's a lot of attention on the Canadian dollar and on Canada in general this week. And I think Scotiabank, I was reading one of their notes towards the back end of last week, summed it up very well as to why that is. And it's because there's nothing going on elsewhere, not because everyone is suddenly interested in what's happening north of the border over in the US. But yeah, I like this. I mean, it's one where you've got very, very clearly defined levels on either side. You've got key risk events in the pipeline as well. And you can wait for price to get to one of those levels, see how it reacts and trade it appropriately. It's not particularly necessary. I mean, I personally don't have a strong view on the Canadian dollar at the moment. It's not really necessary to have one at this stage. It's more a case of waiting and seeing when and if opportunity presents itself, I should say, and then taking advantage of it by the planning that you've done in advance, as you've handily done already on that chart.
Yeah, and one thing I like about the dollar CAD and sometimes the CAD in general is that it can be very good technically. I mean, you can see from the chart there, when you get a solid level, it really plays well. There's another one, if traders want to have a flick to their Euro CAD chart, with mooching again round about this, this 146.5 level, which has, again, been a really solid level going back months and months. And so when it plays nicely, it's a nice one to trade.
Indeed. Canadian traders have clearly got very sharp colouring pencils then in that case, their technical trading. Right, I want to take a trip down under. I want to look at the Aussie dollar. The Aussie's an interesting-ish one, as interesting as anything Australian ever is, because Chinese equities have started to recover a little bit over the last week or so. The recoveries are relatively short-lived. I mean, the rallies that we're seeing in China are being sold into on an intraday basis, but we are seeing a series of higher highs and higher lows if you look across the board more generally in terms of Canadian equities. So Canadian equities, Chinese equities, all over the place here. What's interesting, getting back to this, is that the Aussie dollar hasn't really joined in and is struggling to make traction above the 65 handle. I think there's a couple of reasons for that. You've obviously got this ongoing demand for the dollar, as we've touched on at length already on the program today. But also you've got, I think, expectations that are relatively dovish for the RBA. I mean, everyone is pretty much thinking that their tightening cycle is over. Obviously, if they said something different in their meeting, then, take that rather than what I'm about to say. But Philip Lowe is basically done. Michelle Bullock seems a little bit more cautious, a little bit more dovish than Lowe himself. So further tightening looks a little bit of a long shot down in Australia. And I think, again, the fact that we've run into relatively stiff resistance relatively quickly on this rebound at this 65 figure, I would be in favour of selling rallies here back down to the prior lows, which come in around 63, 65. Unless we see a big sea change in sentiment towards China. It's a relatively tight range, again, relatively well-defined levels, but in terms of the Aussie, given that it seems to have become a little bit detached from some of its typical drivers, I wouldn't be too unhappy fading the move at the moment.
Yeah, I think this one is a pair that's going to be indicative of what we've just been saying earlier in the show about how to trade, the next few months, the data, the central banks. When I look at a chart like this, and I watch the Aussie a lot as well as the Kiwi, what I see is it stopped falling. Okay, we had that move down from July. It was one-way street all the way down from, up near 70, 69s. You couldn't get a bounce for love nor money. Now we've stopped falling. So whenever you want to try and catch the proverbial knife, the first indication you want is that you're not going to continue making new lows. So we've broken that pattern for now. But you're right, we have rallied, and the rallies have faltered. They haven't got too far. Can't hold above that 65 handle. So that tells you that maybe we found a bit of equilibrium between the pressures of the dollar, like you say, and the pressures of the Australian economy and the RBA coming to the end of their cycle. So this is the type of pair you want to be looking at for what next. If the Aussie economy goes off a cliff, then obviously they could be one of the first to start looking at cutting rates. That's going to give you further downside, especially if everything's going still soft landing in the US. But conversely, if it's the other way round, then you're going to see the Aussie dollar rally. And from here, it's very difficult. This is one of those pairs been mentioning, talking about in our chat room last week, where you just want to play between the levels. If you get a test of that low 64s and it holds well, then you nip in with a little buy. If you get up to those 65s and it can't hold well, then you turn a bit short or take profit. So for now, play between the levels, but get ready for if it does decide to move.
Indeed. Right, Dolly, again, I can see you haven't quite written War and Peace. You might have written half of War and Peace this week.
Well, it's summer, I thought I'd give you just a little book to read. Well, I'm reading it anyway, so I don't know what you're moaning about. You don't have to do anything.
I've got to listen.
You just sit there and listen to it, and that's what you want to do. But I'm going to revisit my play of the day from last week, because this one went from break to fake, really. And I want to come back to it, not because it worked, but because it didn't work. We love to give you our best ideas on this show, which help you make more informed decisions in your trading, and alongside that, maybe gives you some key tips how to protect yourself when trading. But we love to cry about the winners, but it's also important to let you know that we do get it wrong from time to time, and how to deal with that. So, as I say, last week was a perfect example. My play of the day was to try and buy the break of 146.50, and but only when it confirmed. So I wanted to see if it broke, came back, tested the level. If it held as support, fine, then I get in and trade it. Well, we got the break, as you can see there, which went into the 147s, quite a decent break, but then turned right around and dropped to good 150 pips pretty much straight after from the high, right back through that break point without blinking. Right after 146.50 becomes resistance again. So it remains so today as well. So it just shows you how sometimes you need these levels to confirm before you start to get in a trade. But you got trading rules, and I broke my own rules because I bought the dip back in at 146.50. I thought I'd have a go, see if it holds. Bought a little bit under that. When it didn't hold, it went all the way down and I got stopped out, lost money. So I broke my own rule there in not waiting for that confirmation move to 146.50. Done my money and get back on the horse and try again. But for now, give or take these extensions, we've got 146.50 above there and below 145, which we saw a little test of. We pretty much remain in range, and the plan is still valid to go with the breaks, and you can go either side of it. So if you get another break of that 146.50, but it needs to confirm, then maybe you get another push up to those 147s. On the downside, nip under that 145 again and come up and test it, and it holds as resistance. Then you can look at shorts, and maybe then you move out of that range. But until then, stays in the range.
Indeed. I'd make a couple of very brief comments here. One is, as you rightly said, this shows why you should always wait for these breaks on a confirmation or on a closing basis, whether it's an hourly, 4 hourly, daily candle, whatever you're using. Wait for it to close. Don't just go, we're above a level, bang, in we go. As you said, that trade didn't work out for yourself, and I'm sure there were perhaps many others out there who were also in a similar boat. The other thing is, and I normally, if you showed me a 15-minute chart, I go, what on earth are you doing? But I'm actually quite glad you've done it this week, because it does prove a broader point, which is that in the FX market, at the very least, for much of the last 2 or 3 weeks, we've kind of just been treading water in very, very well-defined ranges. And when you look at implied volatility, it's on the floor. absolutely on the floor. Implied vols are at their lowest level in a couple of years for most G10FX pairs. And also, if you start looking elsewhere, the MOVE index, which is for treasuries, the VIX for equities, everything very, very low, which just feeds back into that point that we were discussing earlier around whether perhaps markets are a little bit complacent and could be due perhaps a little bit of a reassessment as we move past Labor Day and into autumn.
Yeah, well, I mean, another little tip. I mean, the 15-minute charts are my lifeblood. That's what I watch all day, every day, because they're short enough that it gives you a good overall picture, but it takes out some of the noise. If you go down to a 5-minute chart, then it's just tons of noise. So I watch these every day because intraday they give me where the levels are at, where the decent support and resistance is. And the reason why I didn't want to go with an initial break of that level, you can just see before we broke on that chart, we had little moves above. So it, traded 146.55, then 146.62, and then back down and 146.60. It was just flickering around, and I don't like that. So that's why I didn't have the conviction to go with an initial break. If it had been a really big, solid level where the price isn't getting through whatsoever, that's when I would look for potentially to catch the first break, because usually you've got a ton of stops sitting behind and you get a decent reaction. So there's always two ways to play the break, but you've got to look at the price action and say, right, is this one going to be a blower, or do I need that confirmation before I get right on it?
Absolutely. Right, on that note, let's get on to our plays of the day. So I'm going on a little trip into the equity complex this week. I guess you could call this a kind of transatlantic spread trade. I think anyone who's heard anything I've said or read anything I've written over the last kind of month or so would probably have worked out by now that I'm quite bullish and optimistic about the US, and pretty much the opposite when it comes to Europe. So why not take a position linked to that view? The US equity market's starting to outperform Europe. This is the S&P compared to the Stoxx 50 by its biggest margin since November of last year when you compare them in a ratio. So why don't we buy the US and go short Europe? I think that outperformance can continue. And I think a big leg of that is going to come from Europe. Europe has actually performed relatively well this year, and a lot of that has come from the luxury sector. Demand for luxury goods is obviously going to struggle if China continues to stall in terms of its recovery. That is going to impact other European goods as well. And of course, the other thing that's worth bearing in mind is that even if we do see risk appetite sour, one of the assets that tends to perform pretty well in times of strife is the big tech sector. And where is big tech? It is in the United States. So no targets, no technical analysis, but my view, long US, short Europe. And we'll move on to gold, Ryan.
Yeah, I'm going to look at gold for this one. Another purely technical trade this week. Gold has managed to drag itself back up above the 1930 zone, and it's held a test so far. So talking about confirmations, you can see that we've had one there. I'm looking for that to continue. So buying dips with a stop just below, maybe 127, 125, just below there. Looks good for a decent risk reward trade, for a bounce back, at least to the 1950s highs, perhaps, if not more. What I'd look to do if I got in on this one is slice and dice the trade when in profit. Look to get a stop entry right up to break even or into positive if we get back to that 50s area. Then try and stay in it as long as possible, see where it goes from there, and look at further profit slices taken up to the 38.2 fib, and particularly the 50 fib at 1980s, which has been a really strong resistance level.
Indeed. And you've managed to do that with 6 seconds to spare as well. Blimey, mate. Well done.
Yeah, look at that. Perfection.
Right. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does, and also creating those snazzy new graphics for us. God knows what he's going to come up with for this time next week. That is when we will be back again with another show. Hopefully you can join us then. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, and we will see you in a week's time. Thanks as always for watching, and goodbye for now.